we'll be doing is we'll just be covering a couple of examples of how we've worked with businesses in the past. Then we'll be moving on to common errors found in MI. So that's management information, also covers the terms of management accounts as well. We'll be looking at challenges presenting the MI. We'll be looking at key numbers on how to tell a story and how to present summary financials in tables and graphs. And then we'll finish off the session with a continual feedback loop that I really like, with a Q&A session at the end. In terms of key takeaways, what can you expect? There'll be tips on overcoming challenges in presenting the MI, a recommended list of financial and non-financial KPIs, and also some examples of how to present your numbers. So moving on. So as a firm, we started in 2015, and pretty much from that date, we've been working in the management accounts arena. And we work with a number of clients in a variety of sector that has ranged from professional services to retail to construction to hospitality to tech. So we've seen the management accounts in a plethora of sectors, and we've got a lot of knowledge on what the individual sectors need and require. But just to give you a couple of examples of how we've helped businesses in the past, we started working with a loss-making group in the healthcare retail space. And the problem that they had, they'd grown quite significantly over a number of years, but the owners knew they were obviously loss making, but didn't know where those losses were made. And the reason for that was they had a number of branches, but they didn't actually have the branch performance of each individual branch shown to them in the accounts, because it was all on a consolidated basis. In other words, all the branches were jumbled up into one big profit and loss account, and they couldn't see what branch A, B, or C was doing. And so what we did was we implemented a new accounting software. In this case, it was Xero, and we showed them the profit by branch. And that really unlocked the key to changing the business around, because we were then able to show them the problem areas that the individual branches were suffering, be it low gross profit, too high staff costs, or other costs that were causing issues. And the owners could then make really informed decisions and make changes and let that group return to profitability. And that's exactly what happened. Over the course of 6 to 12 months, the group went from a sort of a loss-making position to making quite a lot of profit, and that's been going on ever since. And it's a great example also of this virtual feedback loop that I'll covering later on, where you get management accounts to help you make informed decisions to ultimately lead to profits within the company. Here's another really good example. We worked with a small hospitality group. They had 5 to 6 outlets when we worked with them. They're still quite a small business. They're much, much bigger now. And what we did was we were able to track food and wet sales for them. And within a very short period of time of us getting involved, we could tell them that the food sales were actually making quite significant losses, and they were actually making gross losses at the time on food sales, which shouldn't really happen. And they were able to make changes in the business, and they were able to then see how their losses turned into profits after the changes that they made, after the information that we presented to them. So 2 really small but useful examples to see how powerful management accounts can be when you want to try and turn the business around. So let's have a look at some common errors in terms of management accounts and management information, also known as MI. So we've over time we've seen a plethora of things going wrong, as you can imagine, and these sort of fall into a multiple of categories. And one of them that happens really often is that items are coded to the wrong account. So what do I mean by that? So say, for instance, you buy some computer equipment like a mouse or a keyboard. That could then be coded to say something like professional fees. So it's something that shouldn't really belong into the account code, but whoever's putting that number in is doing it incorrectly. We then also see quite often the same type of cost being allocated to 2 or 3 different accounts codes. So say, for example, you're buying your paper from Amazon or from Ryman's, you're printing paper. One person might put that cost to, say, printing and stationery, whereas the next person will put it into general office expenses or office overheads. So you can see how quite quickly you could have you might not even be buying that much stuff, but the numbers can end up being all over the place. The third one, and that's a little bit more serious, is there could be either VAT missing. So if, say, for example, with regards to sales, or you could be claiming VAT when you shouldn't actually be claiming VAT, depending on where that invoice came from. For example, if it comes from overseas, there might not be any VAT included on that, or it could be a zero rated invoice. So that's quite serious. You always want to be on the right side of the VAT man, because it's not very pleasant having a VAT investigation, let me tell you. The fourth point, yeah, it does what it says on the tin. Duplicate entries, that could be the same invoice entered either once, twice, or even 3 times over. And bear in mind, this could happen over all kinds of different account codes. So you could actually have the same issue being, something duplicated. It's entered twice. It ends up in 2 different account codes, and either one time there'll be VAT and the other time the VAT will be missing. So there's all kinds of permutations that can happen. And the last thing, but not least, to be fair, is that the items could be entered with the wrong date on. So in other words, the invoice date is say 31st of March, but the invoice is entered when the invoice is actually paid, maybe on say the 15th of April or 28th of April. So that happens really, really often. In terms of low-cost fixes, well, there's a number of things that I can recommend here. The first one is that, provided you know where to look in your accounting system and you know how to pull off certain reports, and we can definitely help you with that, you can look and find these for yourself. So in other words, you can review the numbers and filter out duplicates, wrong dates, or lack of documentation simply by checking these. And to be fair, you don't need to be an accountant to do that. You could check that yourself. The second point that you could do that's also low cost is you should be consistent with where you post your supplier invoices. So say, for example, you could have a list of suppliers from A to Z, and then you could have the account code next to that supplier set in stone, as communicated to everybody who uses the accounting system, and they then know exactly where that thing goes. So say, for example, if Steve enters an invoice, he puts it in the same place as if Simon enters the invoice. And then finally, I think is really, really good to have documented rules and procedures setting out what goes where. So that implies to everything. That implies to how do we raise an invoice, when do we raise an invoice, where does that invoice get posted to, and equally the same with purchases as well. So I think it's really important to have a set of documentation around how the accounting system is run, how the function is run, and everybody knows what is allowed to happen and what should happen. So moving on. What about the challenges presenting the management information? Challenges presenting the MI. So the thing that we see really most often is that most businesses don't have any key performance indicators set up. So the obvious solution to that is to agree a set of KPIs amongst the management team, and you can take advice from us in that regard. But really, what I think is really important is to agree on those key performance indicators and track them on an ongoing basis. The second thing that we see very often that's a challenge for people is that they've got multiple revenue streams. And what I would recommend there is to create separate account codes or tracking codes for each. And the existing softwares that most people use these days, like Xero and QuickBooks, they can do that very easily. The third challenge that we see is that you've got multiple locations. So that applies in particular to small groups which have several locations, and we would highly recommend that you set up tracking by branch to make sure that you know how each individual branch or location is doing. So the bottom line, what do I mean in a nutshell? Basically, setting up and maintaining the accounting system from day one is really, really important, but don't panic if it's not too late. If you've not done that, there's always time for change, and to make a change now is what we say is probably the best thing to do. Now, there might be other challenges as well, for example, challenges for management. And one of those challenges that we see over and over again is, in particular in the SME space, is that management, or at least some members of the management team, have very limited understanding of the financials of their own business. And talk to us if you've got any questions on what you think you should be tracking and what it actually means. What is a debtor, what is a creditor? But also, there's some really good books out there, and we can recommend you some reading lists or some books and websites to go to help boost your financial understanding. The third point, or the second point here on this particular item, is time and budget. We can't, unfortunately, do much about the budget, but in terms of time, I definitely recommend scheduling time to look at your management accounts and to do them on a regular basis, and also to review those figures on a regular basis. And the last point on here is that that sometimes there's no monthly or quarterly routine, and we definitely recommend having either a monthly or quarterly routine to prepare your management account, so you can keep track how the business is performing, because that's so important, and literally it will pay you back in dividends later on. So, using key numbers to identify trends. Well, the first question we should ask ourselves is, what numbers should you actually be using? And as I mentioned earlier, KPIs are really, really important. And what are they? So KPIs, key performance indicators, they should tell you immediately how the business is doing. So ideally, you should be able to look at those figures, and within 30 seconds, you should know how your business has done this month. It's really, really important. So they're the pulse of your business, and you should have them to hand very, very quickly. So what I would recommend is sit down amongst the management team or amongst yourselves, or take advice from us or your accountant, and agree a set of KPIs that are most important for the business. And then you'll include them in the management information going forward. What I definitely recommend is that you should use a maximum of 5 KPIs initially, because actually you'd be surprised. You could almost get to the point where you're having too many KPIs, and in particular when you've not done this beforehand, you want to just limit it to 5 KPIs initially. So you'd now be asking yourself, well, what kind of KPIs should I be using? Well, we've got some examples for you here. So there's obviously the financial KPIs that are part of the MI, and we would definitely recommend looking at sales and sales growth. In terms of sales growth, I would recommend using month-on-month comparison. So your comparison to the prior month is really, really important. Or it could also be comparing those figures to the prior year, just so that you can see how the business is performing on a month-on-month basis. Gross profit margin, really, really important to know how good you're doing in the sector that you're operating in. So get some information, do some research, try and find out what is the gross profit margin of your sector that you're operating in. Really important to have a sector benchmark to know, how am I doing? What you could do also is identify your key competitors. If they're larger businesses, and chances are there will be larger businesses in your sector, you could take their accounts off Companies House. That's a free service that doesn't cost anything. You can pull their accounts because that's in the public domain. If they're large businesses, they'll file a profit and loss account, and you can see what kind of gross profit margins they're doing. So at least you have got some idea of what you're working towards. That's really, really important. Then the next point is earnings before interest, tax, depreciation and amortization, also known as EBITDA. We'd recommend to track that on a pound or percentage margin basis. Actually, the same applies to gross profit margin. Definitely track that in terms of a hard number, and also gross profit percentage. But a lot of bankers and a lot of finance and investors use the EBITDA figure to track, the underlying profitability of the business. So it's really good benchmark to have in terms of tracking that in the regular MI. Cash, always important. Cash is king. That's that saying it applies now, and it's always been like that, and it will always be like that going forward, because obviously you don't have enough money in the bank, you won't be able to pay your suppliers and your other bills. Very, very important. Keep that monitored on a regular basis. Stock and inventory, really, really important. If you're a retail business and you've got most of your money tied up in stock, you really want to know how much money have I got tied up in my stock in my shop or in my warehouse. And crucially, if you're overstocking, say for example, if your turnover is normally 500,000, but this year your stock is normally say £100,000, and then your stock and your turnover drops to say 400,000. Well, in theory, your stock should be lower this time around. It shouldn't be 100,000. It should be maybe 80,000. So you need to adjust your stock back downwards. The only way you'll know that is if you track your stock and your inventory. Debtor days and creditor days. So obviously, remember, debtor days, they tell you how fast your suppliers, your customers are paying you. So you've got a number of customers. Your debtor days, they will tell you how fast your customers pay you, and your creditor days, they tell you how fast you pay your suppliers. So obviously, what you really want to do, you want this number, this debtor days number, to be smaller than that number, because you want to get this money in faster than you're paying out to your creditors. That's really important. So remember that. Try and get paid quicker. And actually, we've got some really good resource on our website. We've got a number of articles on how to manage your debtor days and manage your creditor days. So have a look at our website after this webinar webinar to see how you can manage those a bit better. Expense to sales ratios, really, really important. A lot of our customers track wages as a percentage to sales. So say, for example, they could set a benchmark of say 20% of wages as a percentage of sales. So they kind of know, broadly speaking, how much they should be spending every month. So non-financial KPIs. So what do we mean by that? Let's have a look at this, and this varies by sector. And the key question you should be asking yourself in this regard is, what are the drivers of my business? And that will be individual to each and every single business, even within the same sector. And the other really, really important question you should ask yourself is, how can I get hold of this data easily? So there's no point having a KPI or, well, in particular, a non-financial KPI that you can't get hold of and that's not at your fingertips. You need to get hold of this information really, really quickly, and it's to be something you should be monitoring every single day or every week. So bear that in mind. That's really, really important. So let's have a look at some different sectors. So for pharmacies, it could be, say, the number of prescriptions. For GPs and physios, it could be the number of appointments or treatments that they give out to clients. If you're a professional services business, it could be the number of projects you're working on, or the number of chargeable hours that you're clocking up for the work that you're doing. For other sort of general businesses, it could be just the number of customers you've been serving. If you're in food and hospitality, it could be the number of food orders you're processing, or the number of covers that you've got in say in a restaurant. In terms of businesses that operate on the web, it could be number of website visits, it could be the average basket price or the average order value. So I think you get the picture here. It really is individual to the sector and to your business, but I would recommend having maybe 2 or 3 non-financial KPIs, but maybe 1 or 2 as a minimum would be recommendable. So how do you present summary financials in tables and graphs? So first of all, let's have a look at some tips that we can give you to give you a bit of context. So we would definitely recommend using graphs because they're really powerful and easy to understand. And what's really, really important about this first point is that you don't have to be a financial genius to read a graph, right? A picture says more than 1,000 words. And if you see a graph with 2 or 3 lines on it, pretty much you can understand what's happening within about 10 to 20 seconds. It doesn't take a long time to figure out what's going on there. The second point I'd like to make is that you have summary tables, because they're really, really good at cutting through the detail of a myriad of figures. So if you've got a summary table of figures, of those figures that are really the most important figures in your business, use that at the start of the management account set. Look at that. The detail can come later. That's absolutely fine. The other point that I'd like to make is these non-financial metrics that we covered earlier on. They're really, really important, because the thing is, what they do is they allow you to understand what the numbers are and how they're presenting to yourself. So say, for example, you're running a web-based business and the sales go down. Well, for example, if we'd have the number of orders, the number of website visits for that web-based business, we could then see, well, the number of website visits have gone down and therefore we've got no lower number of orders. And then it could be that, for example, based on that, you need to make changes in your SEO so that you know the number of website visits will go up. So it's really important to use these non-financial metrics to connect the dots. The last 2 points are really about context. So we would recommend having sort of, say, on a graph, 6 months worth of data, so you can spot a trend, or you've got some kind of comparative to look at to make sense of those numbers. You need to see a figure in context. Looking at it on its own doesn't really help you much and doesn't really give you much of an idea of what's going on. The other thing that I would also recommend is compare your current month figure to the prior periods, either on a monthly basis or on a year-to-date basis. And you can do this in pounds and percentage, and we'll give you an example of that in just a second. So those 5 things are really, really important, and we'll see how that looks in practice. Now here we can see some example graphs and table, and this first graph is really one of my absolute favorites. I know it sounds a bit sad, but I really do like my graphs. And you can see straight away how this business has been performing over the last 6 months. You can see here October has done really, really well. We've gone the highest level of turnover with the highest level of gross profits. And again, here you see here, this is a lot worse in comparison, lower gross profit margin, lower sales. And again, you don't have to be a financial whiz to figure out what's going on with the business here. Moving on to this graph here, EBITDA this year versus last. You can see here the business is slightly more volatile this year. In other words, its profits going a bit up and down. But again, you don't have to be a financial genius to figure out that actually this year we're doing much, much better than last year. So whilst profits are going up and down, we've made a huge increase here, a big increase here as well, and then a big increase there. And generally the business is doing much, much better. So those are some really useful graphs for you to see. Let's have a look at some tables here. And this is where this comparison goes on from this year to last year. So here we can see, whilst in percentage terms, there's not been a huge change here, on a pound value term, this has gone up massively. And this is really where percentage and pounds really help you understand what's going on in the business. And it's a really useful summary table. And you can see how the business has been tracking on a year-to-date basis. And also you've got the breakdown of the individual elements here as well. And here's just a short table to show you the KPIs on a monthly basis. You've got both KPIs on a financial basis and a non-financial basis. For example, new customers here down here. Very, very useful to see this. So let's move on to the continual feedback loop. This is the last bit of the session, and let's cover off, well, why does that help you make better decisions and bigger profits? Well, let's see what you first have to do initially. You need to set up your management accounts as we suggested, and you need to maintain that on a regular basis. And what that will then give you is a good quality set of accounts and KPIs that can then be used for further analysis. And what you need to then be asking yourself is, well, where are we making money and where are we losing money? And if you've got a good set of accounts, they will then tell you the answer to that question, right? They will give you the answer to this question. And then on that basis, you can make informed decisions how to run the business more profitably. And usually it boils down to what do we want to do more of and what do we want to do less of? So you're basically changing the course of direction of your business to, obviously, or let's assume that's nirvana, is higher sales and higher gross profit. And then the management accounts, the next set of management accounts will then be able to tell you, well, was the decisions that we made, were they good decisions or bad decisions? Because you'll have feedback for your management accounts because you can see the results of your labor. And then going forward, you'll be continually be able to assess how the business is doing by asking the same question: where are we making money? Where are we losing money? You'll be making informed decisions and changing the course ever so slightly because you might need a slight course direction, and then you'll be getting feedback from your management accounts on the decisions that you've made. So that's the virtual circle, and that, let me tell you, that really led to the turnaround of so many businesses that we've worked with, just using this process by having really good management accounts and being able to give them pretty much instant feedback on the decisions that they've made because they've had regular management accounts and they use that to do their analysis. So that's the end of my presentation. I'll pass over to you guys for some questions, and I'm happy to take them now. Many thanks.
Thank you, Sean. So our first question from Adele, is there an ideal window of time to publish MI to ensure the information is relevant for the continuous feedback cycle?
Yeah, I'd say there is. I mean, ideally, you want to get your management accounts done, I'd say, within 30 days of the month end. So say, for example, your month end is 30th of June. And then ideally you should have your management accounts by, say, 31st of July or maybe the first week of August at the very latest. So I reckon 30 to 35 days preferably is the time window you should get them done by. All our clients are basically being served on that basis. So we usually have a plus 30-day turnaround for our clients in terms of getting them that information. Thank you.
Great, thank you. Feel free to add any questions in the Q&A box on the Teams browser here. I have a couple of other questions that were sent in earlier. Would you suggest including commentary in addition to graphs or summary tables to explain unexpected trends to management?
Yeah, I'd definitely recommend that because otherwise, if they just see the numbers by themselves, they might not really know why something's happening or what's exactly happening. So it's or they might be looking at the wrong in inverted commas figures, or the figures that aren't so important. So I would definitely add some commentary. We do commentary in all our management accounts packs, and even if it's just a short email. So say, for example, if you don't want to write, War and Peace, and not that we do that, but if you don't want to write too much about it, you could just do it in a covering email. But I think it's really, really important to have commentary to explain the figures and to help people understand what's going on in the the business, really important. We also actually provide video commentary on our management accounts as well. So I think, yeah, it's absolutely vital. Very, very important.
Cool, thanks, Sean. I can't see any other Q&A questions in the box, so I have got one more if no one else wants to ask anything at this time. Someone said, my business performance is seasonal, so monthly comparison isn't appropriate. What would you suggest is best to use for comparison?
I think on that basis, I think if you do a prior year comparison, so you know how the business is doing compared to the prior year, that's probably the way forward, because month on month can be a bit tricky if there's a seasonal business, say, for example, in particular, where you've got a business that is really does a lot more business, say, during, I don't know, winter or summertime. Let's take an extreme example, for example, ice cream vans. Yeah, you wouldn't really want to compare, you know, say 1 month, which is just, you know, just after the summer to the summer months, because that really wouldn't be fair. So you should really be comparing that to the prior year period. So yeah, I would highly recommend that you do that more on a prior year basis rather than on a monthly basis. Monthly basis helps, it's useful, but if for seasonal, it's probably prior is probably better overall.
Cool, thank you. So we've got a question from Babalola in the question box. How do we make business owners interested in management accounts?
Well, let me tell you, I mean, it's a good question. I personally think that if obviously the reason why you're running the business is to make money and to make a profit and to make a living, and really the management accounts, as I said, they can be used as almost like a map to steer your business in the right direction. So say, for example, you want to get from A to B, B is your destination, you want to grow sales and grow profits, and the management accounts really tell you exactly how the business is doing. And because ultimately, if the numbers are being processed correctly and they're done not in a timely fashion, numbers don't lie, and they should be telling you, you know, what you should be doing more, what you should be doing less. So you could be working away, you know, 60 hours a week or 80 hours a week, working really hard, and if you don't know what the results of your labor, what the fruits of your labor are, then unfortunately, you know, there's no way you knowing that without having a decent set of management accounts. And so and if you're doing the right thing or the wrong thing, your costs might be too high. If you don't have management accounts, you won't be able to know that. And let's face it, you don't want to wait once a year to do your statutory accounts through your accountant to find out how you're doing. I mean, well, maybe some people are doing that, but I personally wouldn't recommend that.
Oh, thank you. I noticed Sam had his hand up, but Sam, if you've got a question, please type it into the chat. Not into the chat, into the question and answer box below. And otherwise, we'll conclude this session. I'll just give a second if he does want to write something in. I haven't seen anything come up yet, but yeah, it's kind of that's a really good. How because there is always that thing of how do you sell it to people. I mean, we've got people interested on this call, so I think that's a good start.
Very good. Well, obviously we're going to be much more interested in management accounts than most people. So, but to be fair, I can honestly say a good set of management accounts is the foundation of a successful business. It really is. Especially as you grow. Maybe, you know, if you're quite small initially, you might think, oh, do I really need management accounts? But you should have some kind of feedback in terms of how you're doing. And management accounts are, you know, they're internal. It's an internal document. It doesn't go externally. But let me tell you, if you're applying for funding or you're trying to get investment on board, you know, it could be funder could be a bank, an investor could be someone who, you know, wants to buy shares in your business. They will want to know how you're doing, and unless you prepare management accounts on a regular basis, you won't be able to tell them. And so in terms of, particularly when you want to grow, it's really important to be able to have your pulse on the numbers.
Right. And obviously you have got case studies where you have shown that by having better management information, it has led to more profits for businesses.
Absolutely. So, yeah, it absolutely, you know, it definitely works.
Proof is in the pudding, isn't it?
Exactly, definitely.
Great. Well, I haven't had any other questions, so thanks everyone for turning up today. It's lovely to have you listen to our session, and we hope to hold many more. Oh, we've got some claps there, Sean, on the reactions.
Thank you very much.
So yeah, it's great
to
hold this session, and we hope to hold many more. Okay, take care. Thank you very much, everybody.
Thank you. Bye-bye.